question is, what is inflation? What drives inflation? And then what should your trading strategy be?
In my view, currently, Bitcoin is not proven to be a hedge. It can certainly set up to be one as the Tina effect is shifting. So that's kind of my opening on that, and I wanted to get your view on
that. Well, I mean, the first question is, what is inflation? The second question is, what drives inflation? And the third question is, what should your trading strategy be? And I would start with the first question, what is inflation, right? And if inflation is the appreciation in the price of something, but the CPI, the 7% number, is just a single measure of a market basket of consumer goods. It doesn't even include, a house purchase, for example. So we know the inflation rate on energy is much higher. We know that, like, Canada just announced, like yesterday, that the housing prices are up like 25% or something. So we know that you can find a basket of consumer products, like a house or like certain concierge healthcare or high quality education or energy or meat. It's going up faster than this 7%. We also know that if you want a market basket of assets, they're going up, right? The inflation rate for assets is 21% according to the S&P 500 index over the last 12 months. So I think that the first thing we observe is there's lots of different inflation rates of different market baskets. And the lowest inflation number we're going to see is the CPI number, because it's almost cherry-picked to be the things that are least likely to go up in price, right? And so if you look at the headline inflation number everywhere in the world, it's the lowest price appreciation that a government might, with a straight face, represent to its population. And so that's somewhat disturbing when you look at the nominal inflation. I'll call it nominal, but it's really the nominal CPI inflation rate in Argentina, if they say it's 40 or 50%, or in Turkey or someplace. When the government says it's 40%, that means the actual inflation rate is higher. In my Twitter, people will say, well, the real inflation rate here is 120% or 80%. The government says 40%. The government says it's 7% in the Western world, but we know that the cost of housing is up 25% or 20%, and we know the cost of gasoline is up, whatever, 50%, some extreme amount. So I think that's very important, because if you're a trader or an investor and you're trading and making investment decisions based upon inflation data, and you're fixated upon the CPI inflation number as opposed to real estate inflation number, asset inflation number, the producer price index, or commodity inflation numbers, or something else, then what are you trying to hedge? Like, what you're trying to hedge against a market. Let me say it a different way. The CPI inflation rate is the rate at which subsistence is escalating. The cost of subsisting as a middle class or a lower middle class consumer is going up at the CPI level. The cost of succeeding, the cost of success, has to be going up at the asset inflation level. And a market basket of asset, the best surrogate for that would be maybe the S&P index, but even that's not a perfect surrogate, because the S&P market basket is cherry-picked and it's being diluted and manipulated. So you kind of have to take a market basket of scarce assets, trophy real estate, trophy luxury items. If you put that together, you have a different number. But I would think, rule of thumb, it seems to me that the actual asset inflation rate, or the inflation rate, the rate at which you have to appreciate or improve your assets to keep up your wealth, to preserve wealth, is about triple what the nominal inflation rate is that the government tends to report. If they say 7, it's probably 21. When they say it's 20, it's probably 60. When they say it's 40, is probably 120. And you can find that just by tracking asset prices. So I think that's the first question. If you're an investor, you're trying to preserve your wealth or accrete it, right? So your hurdle rate is not the CPI. For example, the CPI was 2% or less for a decade, but every rational investor knows their hurdle rate was 10%. The S&P index was going up 10%. So I think that that's the most important first observation, because otherwise you get wrapped around the axle on the CPI print number, and then you're investing against that number, and you've just cherry-picked the one number which is the least likely to appreciate in price, which has itself been managed, right, by hedonic adjustments. You know, we used to have at one point the cost of housing, right, in the inflation index, and then it became the rent equivalent, and the rent equivalent isn't actually estimated by looking at rents. It's estimated by a survey. You know, like it's like we got to the point where we're still using Nielsen surveys of 1,500 families to see what people are watching, instead of just going to Netflix and seeing that 87 million people did this last week. So I think that's the first observation.
Just to emphasize what you just said, basically definitions have been changed over many years in terms of what inflation is, and it has been generally redefined, in my view, to give central banks the ability to have a rationale for staying easy to start with, right? But now, obviously, we're in this environment. I mean, 25% housing price increases is insane, and you know, the official explanation always being this is just part of, you know, lack of supply. It's just simply not true. I have a chart in a little bit we can show about mortgage-backed securities in the Fed. It's enormous what they have done. And to your point, I think the issue is for people in general to keep up, for example, with the S&P. That hasn't worked really well for hedge funds last year, for example, right? Most hedge funds dramatically underperformed the S&P. I mean, you're in a market cap based index that's driven by a few massive mega cap stocks. The overall index has not performed, the overall stock universe has not performed that well at all. So it is very tough to keep up with that headline number.
Yeah, it definitely is, and it's amazing how many hedge funds don't yield 20% return in the last 12 months, right? It's interesting, but I'm not here to criticize hedge fund strategies. I'm here to criticize the metrics that people use to make rational decisions. So my first observation is the frame of reference is critical, right? There's the old axiom, we can't tell people what to think, but we can tell them what to think about. So if I just feed you a nonstop stream of CPI numbers and you don't question the basis of the metric and you react to the metric, how can you possibly act rationally? That's the first observation. The second is there's another, in my view, a myth. A belief, a deeply seated belief about inflation, which is not true. The first deeply seated belief is that it's CPI, not true. The second deeply seated belief is that it is monetary phenomena. Like there's that phrase from Milton Friedman, inflation is everywhere and always a monetary phenomena. It gets repeated ad infinitum. Not true. Inflation, if we just inspect it from first principles and ask the question, what causes inflation? Well, if I double the money supply and I keep the quantity of products and services and assets fixed, then presumably you'll get inflation, and there'll be some mixture, right? Of will it be the assets double in price, or will it be the products that double in price, or will the services double in price? You will get inflation. So yes, it is true that it is partially a monetary phenomenon. It is also due to fiscal policy. If the government chooses to spend twice as much as it takes in taxes, right, the government will have an impact on inflation. If the government were to go out and basically offer subsidized scholarships to every student in the country tomorrow, pay their tuition, well, we know that causes inflation in the cost of education, right? If the government bought up every automobile coming off the assembly line for a police taxi, or a police system, police cars or taxis or something, that would drive inflation in cars. So the government policy also drives inflation. And then the third issue is all public policy drives inflation. If the government issues labor policy, which if the government said you can only work on Monday, is it not obvious that the cost of things would go up if people only work 8 hours a week? If the government puts in place tariffs, does not it drive up the cost of imports, right? You'll get inflation in things that have import components if the government puts 100% tariff on imports. If the government puts any kind of wage or price controls, or if it puts any kind of manufacturing controls, if the government, like for example, if the government gives you unlimited patent protection on a drug for 1,000 years and lets you patent every aspect of the drug, would you not be paying like $500 an aspirin tablet right now? Right? Like the government can, through public policy, drive the price of anything and everything. So even if the monetary supply was fixed and it did not increase, right? If we had complete hard money, as long as there's government policy, you're going to get inflation. Now, the final, observation is inflation could be driven by, acts of nature, right? Force majeure, right? A tsunami, a hurricane, right? An earthquake. It can all drive inflation. But let's say in the absence of acts of nature, right? Then inflation is primarily driven by government policy, all policy. Okay, so if that's the case, Sven, then the implication of that is even if the central banks raise the interest rates to 20% tomorrow, they might not necessarily eliminate inflation. If the minimum wage goes to 30 pounds an hour or 100 pounds an hour, you're going to get inflation, right? Even in the presence of increasing interest rates. So I think that there's a certain presumption that somehow all the inflation was created by monetary policy and all the inflation can be solved by monetary policy, and the central bankers are the only focus here, and they're not. So yeah, I do agree inflation is a monetary phenomena, but not solely a monetary phenomena. And the implication of that is that regardless of your opinion of what the central bank did or what they're going to do, it doesn't necessarily dictate what your solution should be. For example, if tariffs go to infinity, and if labor rates go to infinity, and if regulations about production, like stores can only open on Monday afternoon from 1 to 5, if those regulations go to infinity, then you're going to want to be invested in an asset that does not require import-export, does not require labor, right? Does not. So that implies that you'd want to hold digital energy. You'd want to hold a purely digital asset. Now, you could hold Google, but if the government policy was to put a tariff or a tax on online advertising, you wouldn't want to hold Google, right? So whatever's going to get regulated is going to get inflated. And the question is it going to be timber? Energy policy drives inflation in energy, right? Labor policy drives inflation in labor, right? Technology policy drives inflation in technology. Tariff policy drives inflation in imports. So the real question is, what is the government's policy going to be for the next decade? And then what is the safest investment portfolio that I could absorb? One can make an observation that pretty much everything in the S&P index has not worked for the past decade other than like big tech. Like, is it like 90, 95% of the returns of the S&P index is big tech? Okay, so if you have a pure digital monopoly, right, then that's working. What's worked over the past 18 months? Like Google, Facebook, Microsoft. Amazon's not even working that well, right?
No,
but you could say
it's flat for over a year. Yeah.
But what is Amazon's exposure is to millions of employees. Amazon's got to deliver stuff with truck rolls. They have to have supply chains, right? They have to move product in the real world, and people have to touch it. And it's a very labor-intensive, product-intensive business model, whereas Google is just pushing electrons back and forth. So I think the big picture here is first figure out, what does inflation mean to you? Are you trying to subsist, or are you trying to succeed or be successful? And the second is, what is causing the inflation that you see? And it's obviously, it's primarily government policy. To a lesser extent, it's acts of nature. You could argue that the pandemic drives inflation, but really it's the government policy reaction to the pandemic that drives inflation, and and your estimate of what they will do over the next decade is important. And I guess now we get to trading. Well, what's the right trade? Well, it depends upon your frequency. Like, what's the right trade for 1 day, 1 week, 1 month, 1 year, 1 decade? So let's start with my observation. I can't tell you. I'm not smart enough to figure out an hour, a day, a week, a month, or a year. Like all of those are too high frequency. I think it's much easier to discern a decade. Like over a decade, I can tell you that Amazon will grow, Google, Facebook, Microsoft, Apple, Bitcoin. Why? Because they're digital transformations of digital music, digital maps, digital books, digital retail, right? Digital entertainment, digital property, digital money, digital energy, digital transformations. You can bet over a decade. Now, let's get in the short frame. Like, okay, why don't you want to buy Bitcoin a year ago? Well, Bitcoin's supposed to be inflation hedge. There's no inflation according to the Fed. Okay, so dump Bitcoin. Why don't you want to buy Bitcoin now? Well, the Fed admits there's inflation and they're going to do something about it, so they're raising interest rates. So what should you do? Dump Bitcoin now. Okay, well, if it made sense to not own Bitcoin when inflation was here, but the Fed didn't recognize it, doesn't it make more sense to own Bitcoin when inflation is obviously here and the Fed does recognize it? Well, no, because the Fed's going to address it. Well, they're not really going to address it, because the inflation rate is 20%, and they're not going to raise interest rates to 20%. And even if they did raise interest rates to 20%, the inflation was only 1/3 caused by the monetary policy, or 1/2 caused by monetary policy. The other 1/2 of inflation is caused by labor policy, export policy, government policy, all sorts of other commercial and energy policies. If we make it impossible to use natural gas and crude oil, right, in a world where everybody's house is wired with natural gas and crude oil, you're going to drive inflation over the near term as people have to rewire everything. So I think that I would say I'm humble about my ability to trade in the near term. I just look out over a decade and I look at the big trends. And when I look at inflationary policy, my question is, what is the government policy going to be, a full spectrum across every aspect of the economy, energy policy, labor policy? And then I ask myself, what do I want to own that's going to be exposed or not exposed, and how exposed? And what is my risk of that portfolio to government policy going forward?